Picture two people opening their retirement statements on the same Tuesday morning in 2022. Same age, same cautious investor. Both did exactly what every financial advisor, every retirement brochure, every well-meaning parent told them to do. Put the risky stuff in stocks. Put the safe stuff in bonds. Sleep easy. One opens his statement and sees his stocks down. Expected. Markets do that. Then he looks at his bonds. Also down. Massively down. The thing that was supposed to catch him when the stocks fell just fell harder. The other person opens the same statement. Same carnage. Except she understood exactly why it was happening. Knew it was temporary. Didn't sell a single thing. And quietly bought more while everyone else panicked. Same crash. Same portfolio. Completely different outcome. And the only difference between those two people was one understood something the other didn't. Something most people with finance degrees can't explain clearly. Something that controls your mortgage rate, your car loan, your retirement account, and whether your government can afford to pay its own bills. It's coming. Hold on to that. It's the bond market. And it is the largest, most powerful financial market on the planet. Bigger than every stock market on earth combined. It prices your entire life. And almost nobody understands how it works. My name is Peak, and I've spent way too much time reading about a market that has all the personality of a tax form and twice the body count. If you've ever wondered why mortgage rates doubled in 2 years, why your safe retirement fund suddenly wasn't safe, or why a bond market spooked an entire government into reversing its own policy in under a week, hit subscribe. Because by the end of this video, you'll understand money better than most people with finance degrees. That's not a compliment to you. It's an insult to finance degrees. Let's start stupidly simple, because everyone overcomplicates this and it costs them money. A bond is an IOU. That's it. Somebody needs money. A government. A company. Occasionally a city that wants a stadium nobody asked for. Instead of going to a bank, they borrow from investors. You hand over $1,000. They promise two things back. A fixed interest payment every year, called the coupon, and your $1,000 back on a specific date called maturity. That's the whole product. An IOU with a due date and a fixed interest rate. When the US government runs a deficit, which it always does, it sells these. They're called treasuries. When Apple needs cheap cash, it sells corporate bonds. When a company with shaky finances needs to borrow, those are called junk bonds. Wall Street politely renamed them high yield bonds because junk doesn't look great in a brochure. Simple enough. But here's the part that 90% of people get wrong. The part that cost millions of retirees a brutal 2022. The single most important idea in this entire video. Pay attention here. Let's say you buy that $1,000 bond paying 2%. You get $20 a year. Fine. Boring. Whatever. A year later, interest rates rise. Brand new bonds, same $1,000, same borrower, now pay 5%, $50 a year. Question. Who is buying your bond? You walk up to an investor and say, hey, want this thing that pays $20 a year? And they look at you and say, why would I do that when the government is handing out $50 a year right next door? Your bond didn't change. It still pays exactly what it promised, but it's now the financial equivalent of a used iPhone 11. It works perfectly fine. Nobody wants it at full price. The only way to sell it is to drop the price dot. You cut it until that fixed $20 payment works out to roughly 5% for whoever buys it, which means selling your $1,000 bond for somewhere in the $700 S.
You just lost a couple $100 on the safe investment. Here's the rule. Tattoo it somewhere it won't fade. When interest rates go up, existing bond prices go down.
When rates fall, existing bonds go up. They sit on opposite ends of the same lever dot. Every disaster in the rest of this video is just this rule operating at a bigger and bigger scale. And the first place it shows up is in a single number that quietly runs your entire financial life. If someone asked you to show them the one number that controls the economy, you wouldn't show them the Dow. You'd show them the yield on the 10-year US Treasury. Right now, it sits around 4.5%. And here's why that matters, even if you've never bought a bond and never plan to. When a bank writes you a mortgage, it doesn't invent the rate. It looks at the 10-year Treasury and asks itself one question. Why would I lend money to a random person for 30 years when I could lend it to the US government risk-free at 4.5%? The answer is it wouldn't, unless you pay more dots. So the bank takes that Treasury yield, adds roughly 2 percentage points for the privilege of you being a regular human who might lose their job. And that's your mortgage rate. 10-year at 4.5%. Mortgages at 6.6%. That's not a coincidence. That's not a conspiracy. That's the formula. Back in early 2021, the 10-year sat near 1%. Mortgages hit 2.65%, the lowest ever recorded. People borrowed like the money was expiring. Home prices jumped 19% in a single year against a 50-year average of about 4%. Then the 10-year ripped higher. Mortgages crossed 8% by late 2023. And the housing market froze mid-bite like someone hit pause on a nature documentary. The bank didn't do that to you. The bond market did. And it doesn't stop at houses, car loans, credit cards, student loan refinancing, the rate your city pays to build a school, the rate your employer pays to fund its expansion, all of it priced off treasuries. When yields rise, is every borrower in America gets the same rate increase at the same time. Companies that loaded up on cheap 3% debt in 2021 suddenly faced refinancing at 7%. When your interest bill doubles, you don't write a sad email about it. You cut costs, which is a polite way of saying layoffs. A chunk of the job losses in 2023 and 2024 weren't really about the economy. They were the bond market quietly repricing everyone's debt. Now here's the part that should genuinely unsettle you. The bond market doesn't just set your interest rate, it predicts the future. Normally, lending money for 10 years pays more than lending it for 2. Longer wait, more reward. Makes sense, but occasionally that flips. Short-term bonds suddenly pay more than long-term ones. It's called an inverted yield curve, and it means investors are so nervous about the near future they're stampeding into long-term safety. The Fed checked the track record. That signal has correctly called every US recession since 1955. 9 for 9 plus 1 mulligan in the 60s. Your horoscope wishes it had that hit rate. So while financial media argues about vibes, the bond market quietly raises its hand and says, trouble's coming. It is almost always right. This is why political strategist James Carville once said he used to want to be reincarnated as the president or the Pope . But now he'd come back as the bond market . Because you can intimidate everybody. He wasn't joking. And in a few minutes, I'll show you the bond market intimidating an entire country into firing its own leader in 45 days. But first, let me demolish the biggest lie in personal finance. Here's what every financial advisor, every retirement brochure, every target date fund has told you for decades. Stocks are the risky part. Bonds are the safe part. 0.60% stocks for growth. 40% bonds as your seatbelt. Then 2022 happened, and the seatbelt strangled everybody. The Fed jacked rates from basically 0 to over 4% in 9 months to fight inflation. And remember our rule. Rates up, existing bond prices down. The broadest US bond index fell 13% that year. The worst year in its entire history, going back to 1976. Long-term treasuries, the safest assets on the planet, got obliterated. Long-dated government bonds lost nearly 40% in 2022. One researcher found that's the worst year for those bonds going back to 1754. Not 1954. 1754. T here were 13 colonies. We hadn't invented America yet, and bonds had never had a year that bad. The classic 60/40th retirement portfolio lost about 17%. Because for the first time since 1974, bonds didn't cushion the stock crash. They piled on. Millions of retirees opened their statements and discovered the safe sleeve of their portfolio was the thing bleeding . Were they lied to? Sort of. Here's the nuance nobody explained. Bonds protect you from one risk, the borrower not paying you back. The US government will always pay you back. But there are 2 other risks hiding in the fine print. Inflation, which quietly shrinks what those fixed payments can buy. And the big one, interest rate risk, which is everything we just covered. There's a number that measures exactly how exposed you are. It's called duration. And it is the most useful concept you've probably never heard of. Rough translation. Duration tells you how much your bond drops for every 1 point rise in rates. A fund with a duration of 6 loses about 6% when rates rise 1 point. A long-term treasury fund with a duration of 17 loses about 17% per point . And in 2022, rates rose more than 4 points. Suddenly, grandma's bond fund was moving like a tech stock, except without the upside or the fun. Now here's where this gets cinematic. Because this exact same math, this one rule . Started taking down bigger and bigger targets . First a bank, then a prime minister. Watch the dominoes. Domino 1, Silicon Valley Bank. March 2023, SVB took in a flood of deposits during the tech boom and parked over $91 billion of it in long-term bonds. Safe assets. Then rates spiked . And by the rule you now know, those bonds silently lost more than $15 billion in value . The bank wasn't gambling on crypto or meme stocks. It bought the most boring assets in existence at the worst possible time, funded by deposits that could leave instantly . When SVB sold part of the portfolio at a $1.8 billion loss and asked investors for fresh cash, depositors panicked. And the bank went from fine to seized by regulators in about 48 hours. The 16th largest bank in America, killed by the used iPhone problem. Domino 2, the United Kingdom. September 2022, NU Prime Minister Liz Truss announced £45 billion of unfunded tax cuts. And the bond market looked at the math and said, absolutely not. Investors dumped UK government bonds so hard that 30-year yields spiked more than a full percentage point in 3 days. That detonated leverage strategies inside British pension funds, which were forced to sell more bonds to raise cash. Which pushed yields higher, which forced more selling. A doom loop with the entire retirement system inside it. The Bank of England launched emergency bond buying, later admitting some pension funds were hours from collapse. And my favorite detail. A British tabloid set up a live stream of a head of iceberg lettuce next to a photo of Truss, asking which would last longer, the lettuce one. She resigned after 45 days, the shortest premiership in British history, because the bond market fired her. Carville wasn't exaggerating. The bond market can intimidate everybody up to and including the person running a G7 country. Now here's where it gets personal again, because the biggest borrower on earth is not a cautious actor right now. The United States government's tab is currently around $36 trillion. Big debt numbers are basically white noise at this point, So let me give you the one stat that actually matters. This year, the US will spend over $1 trillion just on interest. Not paying down debt, not building anything, just interest. The minimum payment on the national credit card. For perspective, that's more than the entire defense budget. The United States now spends more money servicing old debt than it spends on the most expensive military in human history, and the customer base is getting picky. Foreign investors used to hold over half of US Treasuries back in 2008. Today, it's around 30%. China's holdings are the lowest since 2008. Washington needs to borrow more than ever. Exactly while its most reliable customers are slowly backing toward the exit. What does any business do when demand softens? It offers a better deal. In bonds, a better deal means higher yield, which means higher rates on everything those yields price, including your mortgage, your car loan, your boss's payroll. We even got a live demonstration of the bond market's power over policy in April 2025. After a chaotic tariff announcement, investors started dumping treasuries. Yields spiked. And within days, the administration paused the tariffs, with the president admitting the bond market was getting, quote, a little queasy. The policy of the most powerful government on earth got reversed in under a week. Not by Congress, not by voters, by bond traders. So what do you actually do with all of this? 5 practical moves. No finance degree required. First, stop donating money to your bank. The national average savings account pays around 0.4%. Meanwhile, 3-month treasury bills pay around 3.7%. Money market funds pay around 4%. High yield savings accounts are right there with them. Same money, same safety, 8 times the interest. Your bank is counting on you never watching a video like this one. Disappoint them. Second, know the difference between a bond and a bond fund. Because it bit millions of people in 2022, if you buy an individual treasury and hold it to maturity, you get every payment plus your full principal back, guaranteed. Rates can do whatever they want. A bond fund never matures. It's a basket repriced every single day, which means when rates rise, the losses show up on your statement and just sit there. Neither one is wrong, but one of them can show you a minus sign on a safe investment. You deserve to know which one you own before it happens. Third, check your duration. It's listed right on your fund's fact sheet. It is your honest risk label. Short duration, small swings. Long duration, you are making a bet on interest rates, whether you meant to or not. The retirees crushed in 2022 weren't reckless. They just owned duration. They didn't know they had. Fourth, if inflation is your nightmare, the government literally sells insurance for it. Series I savings bonds adjust their rate with inflation. Tips. Do something similar inside retirement accounts. Deeply boring, but boring that keeps up with your grocery bill. Fifth, watch the 10-year treasury yield. Takes 5 seconds. When it climbs, mortgages, car loans, and corporate borrowing follow. When it falls hard, the market is usually bracing for something rough. It is the closest thing the economy has to a check engine light, and now you're one of the few drivers who knows what it means. Here's the thing nobody tells you about the bond market. You have been participating in it your entire adult life. Every mortgage payment, every car loan, every dollar in your 401k's stable fund. You were always in the game. You just never got handed the rule book. And there is an entire industry that is perfectly comfortable keeping it that way. But now you know the one rule everything runs on. Rates up, prices down. And you've watched it take down a bank in 48 hours, a prime minister in 45 days, and trillions in safe retirement money. None of those people thought bonds were boring afterward. You don't need to trade bonds. You don't need a Bloomberg terminal or a Patagonia vest. You just need to stop being the only person at the table who doesn't know what that mortgage rate means, because the bond market is going to keep pricing your life either way. The only question is whether you can read the price tag. Now go back to those 2 people from the very beginning. Same statement, same crash. One panicked. One didn't. The difference wasn't income, luck, or a finance degree. It was understanding one lever. Rates up, prices down. And knowing that when the lever moves, it's not the end of the story. It's just the middle of it. The person who understood that didn't need to be calm. The math made her calm for free. Quick reminder, I'm not a financial advisor. This is for educational purposes only. What you do with your money is entirely your call, but you're making that call a lot better informed than you were 20 minutes ago. And I'll see you in the next one.